Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
S&P 500, Beware February, Technical Analysis. This article was written by Andrew McElroy. Summary. Pause. The S&P 500 closed January with a 1.4% gain, setting a positive tone for continuation despite volatile news flow. However, momentum is waning, with February historically weak and a DeMark exhaustion signal suggesting a risk of a 10% plus drop if a reversal materializes. Market drivers include Fed leadership change, volatile cross-asset moves, and potential stabilization in the US dollar that could reduce equity tailwinds. I favor buying early dips near 6,824 and selling strength above 7,050, while monitoring for a failed new high and signs of a broader reversal. Another wild week ended with no real change for the S&P 500. January is in the books, and also saw little net movement despite chaotic news flow. This article looks at why February could be different. S&P 500 monthly. January closed with a small gain of 1.4%. That's important, as at around 11 a.m. Eastern Time on Thursday, the January bar was trading slightly in the red, and a reversal could have been developing. The subsequent recovery nullified that reversal, and without it, we can look for new highs in February. It's also important because a positive January tends to lead to a positive year, while the opposite is also true. I do still think there will be several large drops in 2026, but the above chart fits in with my general view that they should be buying opportunities. As we head into February, I will be watching closely for a reversal, as there is clear momentum loss since October. And February is the second worst month of the year for the S&P 500, with 35 lower closes out of 76. It will also be bar 9 of 9 in a DeMark exhaustion count. This signal has led to a drop of at least 10% on the last 3 occasions. The rally has reached 7,002 and resistance at the major target of 69.58, which is the 161% Fibonacci extension of the H1 drop. After 69.58, a measured move similar in size to the 2020-2022 rally and the 2022-2025 rally projects 7490. I doubt it gets there, at least in this phase of the trend. The January low of 67.89 is initial support, then 67.20, and the October-November lows of 65.2150. S&P 500 weekly. For the second week in a row, the weekly chart looked bearish for a while, on Thursday, as it dropped from the trendline retest. But this was another good example of why we shouldn't jump to conclusions, as a recovery led to a neutral close. As I said last week, I'm staying with a mild bullish bias until there is a clear reversal that sticks. Resistance is 7,002. The broken trend line will rise to around 7,050. Support is 6870, and at the 20 SMA/6789 low, with 6764 a good level just below. No DeMark exhaustion count has progressed due to the choppy action. S&P 500 daily. Last week's article suggested a blow-off rally may be necessary to complete this slow phase of the trend. That looked like playing out as Monday, Tuesday, and Wednesday sessions all gapped higher and 7,000 was broken. Meanwhile, the Nasdaq, QQQ, also broke out of its long-standing triangle consolidation and finally looked lively. Alas, it was another false start, as Wednesday stalled and dropped back into the previous range, and then Thursday dropped sharply. The action remains weak from both bulls and bears, which is typical in a wedge. Unfortunately, this behavior could persist until there is either a strong rally exceeding the blue channel, shown below, to create a euphoric top, or a solid breakdown. Initial resistance is 69.64 to 69, then 7,002. The blue channel will be at 7,050 on Monday, and will rise to around 7,066 by the end of the week. Support is at 68.70.92, 68.24, and the bottom of the blue channel, then 67.89 and 67.64. No DeMark exhaustion count has progressed due to the choppy action. Drivers events. Last week was chaotic, but most of the big stories came to very little. The FOMC meeting had a predictable hawkish tone based on a stabilizing labor market and strong economy. Mega cap earnings were solid enough, although Microsoft MSFT is still being punished for massive capex. At the end of the week, another government shutdown looks to have been averted, as long as the House votes the bill through on Monday. Even the massive military buildup in preparation to strike Iran has only led to talks, at least at the time of writing. The main driver came from Kevin Warsh's appointment as new Fed chair and the almost audible pop in the parabolic metals rally. I don't buy into the view that Warsh is a hawk in dove's clothing to please Trump and get the job. He will still push for a cut or two this year. However, his appointment could lead to some stabilization in the US dollar, DXY, and doubts over the dollar debasement trade. The near-term impact for stocks could come mostly from the volatility in other markets. Metals, oil, crypto, even currencies, USD JPY, have been making wild swings, and that tends to filter through the system as margin calls strain liquidity. It's not a healthy backdrop. There's also the case that dollar weakness was inflating stocks, and that tailwind may now wane. Next week's main event is Friday's release of the jobs report, now that 3 cuts have been delivered and the Fed is on hold until at least June, unless something changes. When Warsh will get his first taste in the spotlight, I assume markets want to see solid data. Unemployment is expected to stay steady at a healthy 4.4%, and a headline number of 50K to 100K would be acceptable. I do wonder if we may see some hotter data again, but that won't really be an issue until there is a series of strong reports. It might give Warsh a challenging start to his term. Remember, he only has 1 vote, and if data heats up, he may not convince other members to vote for a cut. That would be great news for the dollar. Probable moves next week. I remained long and even made a poorly timed attempt at adding last week in case there was a blow-off rally. That didn't work, and buying weakness and selling strength remains the preferred tactic in recent months. With that in mind, I would buy an early dip next week near the bottom of the daily channel around 6,824. If that doesn't happen, I will be looking to sell longer-term positions into new highs around 7,050. Bigger picture, another new high in February that fails could develop into a reversal. Lack of momentum, higher timeframe exhaustion, and seasonal weakness are all working against a sustained rally, and volatility in other markets is a warning. I also wonder if a more stable dollar outlook could weigh. If and when there's evidence of a top, I expect several months of weakness down to the 6,100 area. This article was written by Andrew McElroy. Microsoft, the earnings drop.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.